Hi everyone, I'm James Hart and welcome to this Orbex trader education session where we're going to be continuing with a recent series looking at technical indicators, this week picking up with the MACD indicator. Now, I'm sure some of you are already familiar with this indicator, and if you are, that's great, but if not, don't worry. Over the course of this session today, I'm going to explain exactly what the indicator is and how you can use it in your trading. We'll look at some specific trading techniques, both basic and advanced, as well as talking about some special considerations when using the indicator. Now, as ever, if you have any questions during the session, please just write them in the chat function as we go along, and I'll stop when we get time. I'll also leave some time at the end for any questions that you have. Okay, so let's jump straight in then. What is the MACD indicator? So the moving average convergence divergence indicator, which sounds like some sort of crazy 80s invention, is actually a trend following indicator that measures a short and longer term moving average, the distance between them, to identify directional bias, basically telling us which way price is moving. Now, the great thing about the indicator is that it's also a momentum indicator. So it tells us how strongly price is moving, as well as the direction in which it's moving. So basically, the indicator is measuring the convergence or the divergence of the two moving averages. Now, the further apart the moving averages grow, the stronger momentum is gaining, and the closer together they get, the weaker momentum is. We'll come on to the specifics of the indicator in more detail when we start to look at some examples of it. But this is essentially what the indicator is. So it's a trend following indicator, a trend direction indicator rather, and it's also a momentum indicator. So it's looking at the direction of the market as well as measuring the strength of the underlying moves in the market. However, in terms of its use as a momentum indicator, it's slightly different to the RSI or stochastics indicator in that it isn't a bound oscillator. So for those of you who were in the webinars that we did about the RSI and stochastics indicators, you'll remember that they both have upper and lower limits, and they oscillate between these limits. So the difference here is that the MACD indicator doesn't have any upper or lower limits. So it measures momentum, but it doesn't have upper or lower limits. As I say, we'll discuss the details of the indicator as we move through and look at some practical examples. So the indicator itself, which looks like this on the MT4 platform, and it will show up in the sub-chart section of your platform, so below the price chart. So the indicator has two key elements to pay attention to. So the first is the MACD line itself, which on this indicator shows up as a histogram, okay? So this is the difference between the 12-period moving average minus the 26-period moving average. So the histogram is showing us the difference between these two moving averages. Now, the indicator also has a 9-period moving average of the MACD line itself, and that gives us the signal line. So you can see this red line here. So the MACD itself is the difference between the 12-period moving average minus the 26-period moving average, whether that's positive or negative. Okay, so if it's positive, then the MACD histogram is above the center line, so above this horizontal line running at 0. And if the difference is negative, then the MACD is below the center line. And then on top of that, we also have the signal line in red, giving us the 9-period moving average of that difference. Now, don't worry if this seems a little bit complicated to begin with. As I say, we'll talk through these details and go back over them as we look at some practical chart examples. But these are the basics of the indicator. So we have the MACD line itself, shown as the histogram, and then we have the signal line, which is the 9-period moving average of the MACD. So when it comes down to trading the indicator, then there are several ways in which traders tend to use the MACD indicator, such as trading center line crossovers, signal line crossovers, as well as divergence. And we'll look at all of these different trading techniques now. So let's kick off then by looking first of all at the center line crossing. So the key thing to remember here is the MACD line, as I say, above the center line. So when this histogram is above the center line, as you can see it is here, this indicates that the difference between the 12-period moving average and the 26-period moving average is positive. So this is giving us a bullish signal. Okay, so if you pull up your chart and you see that the histogram is above the center line for whichever instrument you're looking at, this is telling you that the market is in a bullish phase. Similarly, the MACD line, so the MACD histogram below the center line indicates that the difference between the 12-period moving average and the 26-period moving average is negative, giving us a bearish signal. So again, if we pull open a chart, say for the euro, or say for the dollar index, and we can see that the MACD histogram is below its center line, as it is here, then that tells us that the market is in a bearish phase. Okay, so let's look at an example of this on the charts. And here you go. You can see I've highlighted several instances here. So each of these red horizontal, vertical lines rather, not to confuse you, vertical lines that I've put on the chart, you can see these highlight instances when the MACD line, which remember shows up as a histogram, has switched from below the center line to above the center line, or from above the center line to below the center line. So let's talk through now what this means for the market and the relationship between the indicator and the price. So to begin with then, you can see at the start here, the very first section of price action we have, the indicator is to the downside. So these histogram bars are below the center line. This is indicating that the market is in a bearish state. However, at this point here where we get our first vertical line, you can see the indicator has crossed above the center line. So this tells us the difference between the short-term moving average and the long-term moving average is positive, and that the market has shifted into a bullish trend. And you can see from that point that we then get a nice sustained rally all the way up to this point here. And you can see, interestingly, that while that rally is continuing, the MACD line, so the histogram here, stays above the center line. So the MACD line stays positive. So while this rally is developing, if you are continuing to look at your MACD histogram, it would be continuing to support the view that the trend is going to develop further. So once the price action develops up to this point here, you can see we stall out, we get a number of highs here, and you can see that the market starts to come off and starts to move lower. Now, interestingly, also note what's happening to the shape of the bars, because remember, the shape of the bars give us information on momentum in the market. So from this point here, where the bars are at their highest from the bullish trend, you can see price action peaks out, starts to chop around and stall and move lower. Interestingly, note how the bars have also started to come off and move lower in a sustained and consistent manner. So this tells us that from this point here, where price reached its peak, the difference between the moving averages started to decrease. So the moving averages started to converge, okay? So the moving average convergence divergence indicator. So during the start of the trend, you can see that the moving averages were diverging. So they were growing further apart as momentum was increasing and price was rallying further. However, from this point here, price has started to come off. The moving averages, the distance between them, has started to decrease, and this tells us that momentum is weakening. So bullish momentum is weakening, highlighting the potential for a reversal. And you can see at this point here that we do in fact get our reversal. So the indicator then crosses back to the downside. You can see we get our first first bearish MACD signal here. So the histogram flips below the center line, and from that point you can see that we get a long, drawn out sell-off rather in the market. Now again, note what's happening with the size of the MACD histogram bars. So to begin with, while we're in this first period of the rally, price is selling off, you can see the bars on average are getting consistently bigger. So they're getting bigger and bigger and bigger all the way down to this point here where they peak. So during this whole period where these bars are growing to the downside, this tells us that bearish momentum is increasing in the market because the difference between the two moving averages is growing. Okay, and then from this point here, once again, you can see the size of the bars stalls out, and then it starts to retreat and it starts to shrink. So what we're seeing here is momentum in the market, bearish momentum, weakening because the difference between the two moving averages is decreasing. So once again, this highlights the potential for a reversal in the trend. And you can see shortly after that point that price does in fact reverse higher. And at this point here, the indicator once again flips bullish. So the indicator moves back above the center line. We get a small rally here, although it doesn't really go anywhere. You can see we peaked very early on with the size of the bars. And interestingly, we didn't get anywhere near as big as we saw the bars up here, okay? So again, remember, the size of the bars tells us about the momentum in the market, so the strength of the underlying price moves. So the bars start to decrease, the size of the bars starts to decrease, price stalls out, reverses lower, and then here you are, this is where we are at the moment. So the most recent crossover was to the downside. You can see that from crossing to the downside, price has continued to sell off, and then at this point here what we've actually seen is the size of the bars decreasing and a sharp reversal higher. But for the moment we're still in bearish territory because remember the indicator is still below the center line. Now hopefully just from this basic example you can already see just how useful this indicator can be in helping us judge the direction of the trend as well as helping us capture key turning points in price. So we've only looked at a brief period of price action here, and we've only looked at 4 changes in the indicator, but hopefully you get a really good sense of how the indicator maps the moves that we see in price, how it conveys the information about momentum, and how it captures some really interesting turning points. So when it comes down to how you use the indicator then, you can either use it as a directional tool whereby you use the indicator to get a sense of how the market is trading, so you can then align yourself with the trend. So for example, if you pull up a chart and the MACD is below the center line, you know that the market is in a bearish state, and so therefore you should only be looking to trade sell setups. So until the MACD crosses back above the center line, at which point you can then switch to taking long trades only. So this is a really great way to help traders build order into their trading style, and it means that you can use any setups you like. So for example, if you're a breakout trader, you can look to trade breakouts only in the direction that the MACD is giving you, or if you trade candlestick patterns, again, you only look to take trades in line with the direction given by the MACD indicator. So it can be incredibly useful simply as a guide. So if you have a certain setup that you like to trade or a certain strategy, but you're unsure about which direction you should be trading in, MACD can be a fantastic tool for helping you get some clarity on that. Now, alternatively, you can use the indicator to actually execute trades. So looking to enter trades as the MACD crosses the center line. So you'd look to buy price as it crosses above the center line, and you'd look to sell price as it crosses below. So in terms of how traders actually enter trades based on crossovers, the way that I've always found best when operating like this is known as candle confirmation entry. So this is essentially where you wait to enter the trade until after the close of the candle which formed on the crossover. So if you look at this example then of where we got the bearish crossover in the MACD, so you can see we've got this large bearish candle form on the bar that closed bearish on the MACD indicator. So the MACD flipped bearish on this price candle here. However, instead of simply entering short on the close of this candle, what we would do is put an order to sell below the low of the candle. Now the red line is actually the same color as the candle, so it's obscured the low, but the low for that candle was somewhere down here. So essentially what you wait to do is you wait to sell as price breaks in favor of the MACD direction. So this is a bearish signal. So we put an order to sell below the low of this candle. Now the reason for doing this is that waiting for a little bit of extra confirmation on your trade can be a really fantastic way of building in some extra security. So what it tends to do is, if you're waiting for momentum to be confirmed in the market, this acts as another extra bit of safety filter for your trading. Because what you'll find with the indicator, due to the lag in price, or the lag that is in indicators, you'll find there are plenty of times that the MACD line will cross over the center line, but after the initial crossover candle is formed, price doesn't continue in the expected direction and instead reverses. So giving yourself a little bit of extra confirmation and waiting to enter on the break of the candle can help you avoid some losing trades. And you can use this entry mechanism on all trades. And for those of you who've been in some of my webinars or all of them, you'll know that this is an entry strategy which I tend to use across the board. So waiting for candle close confirmation and then trading a break of that candle. So if it's a bullish trade, you wait for the candle to close and you set an order above the high of that candle. If it's a bearish trade, wait for the candle to close, set an order below the low of that candle. So I don't enter the market simply on the close of the candle. So let's take a look at this. So here we've got a good example of this. So you can see price is selling off from this high point here. You can see we've got the decrease in those bars telling us the bullish momentum is waning. We trade all the way down to this point here. You can see price sells off, we get this large bearish candle. Then on the next candle, we trade down to this low point. The indicator itself turns bearish, so we get a histogram printing below the center line, giving us a sell signal. However, you can see from that point there, that was as low as price went for a good period. So from that point there, price actually reversed and traded all the way up higher. So if you'd entered on the close of that candle thinking, right, the indicator has flipped bearish, this is my chance to get in the market, I'm going to sell at the close. You sell at the close and bang, stopped out straight away as price trades back against you. However, if you are being a bit more savvy with your trading, taking a bit of extra care and waiting to trade a break of the low of that candle, because remember this is a sell signal, so in order to enter this trade, we want to see price break the low of the candle that formed on the crossover. If you'd waited to enter at this point, you would have avoided this losing trade. Okay, so just waiting for that extra level of confirmation can really give you an advantage with your trading. However, it's important to add, this doesn't mean that all of your trades will be winners and that you'll avoid taking any losers, because we know that this isn't the case. However, what we are looking to do always is to manage our risk and improve our chances of success. So even a minor tweak like this, even a slight adjustment to the way that we enter trades, can be extremely helpful in the long run. Because as I say, once you've spent some time with the indicator, you'll notice, specifically in situations like this, where we've got price oscillating in a range, so instead of making any clear directional move, we've got price sort of chopping around. Due to the lag in the indicator, there will often be times when we get crossovers and price doesn't follow through. So giving yourself just a little bit of extra confirmation can really help you avoid taking some of those painful and unnecessary losses. Now, in terms of profit targets then, when we're trading the MACD indicator, typically traders will look to trade from crossover to crossover, meaning that, for example, where a trader enters short as the indicator turns negative, so moving below the center line, the trader will typically hang on to their position until there is a subsequent bullish crossover, at which point they will close out their short position, banking any profit or loss, and then they'll enter their new trade, which will be a buying. And then vice versa, if they're in a long trade, the indicator is above the center line, they'll stay in that long trade until they get a bearish crossover, at which point they'll reverse their positions. This is simply known as staying in the market with the indicator. Now, this method can work very well in trending markets, okay? So where we have a lot of momentum and a lot of volume in the market, and price is making very long sustained moves, obviously this can help traders capture large directional moves. However, what you'll often find, and we just touched on it a minute ago, is that in choppier market conditions, where price action is ranging and chopping back and forth, what we'll often see is crossovers failing to give any proper moves in price. And typically, what you can actually end up doing is giving back a lot of your gains. So, for example, if we look at this point here, so the indicator crosses bullish on this point here. So this is the first bullish signal we get here, okay? So you can see this candle here, so it's roughly around here. So price trades all the way up to this high point here. We hit this former high, stall out, reverse. Now at this point here, from our original bullish entry, we're holding good profit, okay? So where are we? Around 140, we've gone up to over 43. So we're around 300 pips worth of profit. However, if we're simply waiting to exit the trade at the next signal, you can see by the time that the next signal forms, which is down here, we've actually come all the way right back down to our entry point and given away all of that profit. Now, this is incredibly frustrating, and it's something which actually dogs a lot of traders who trade not just the MACD indicator, but any indicator on a signal-to-signal basis, okay? Because you have to remember the market spends a lot of time ranging, and typically where you're taking a trend-following approach, which is what trading the MACD crossover is, the centerline crossover, bullish signal to bearish signal, you'll often find in range-bound markets like this, where price makes moves and then reverts to the mean instead of making a strong directional move, you end up frustratingly giving back profits. Now, one way of countering this is to adopt a risk-reward target method, whereby you simply aim to sort of systemize the profit target that you trade. So, for example, on any signal that you take, you aim to bank, say, 2 or 3 times your risk, okay? So whatever your stop is on the trade, you then look to target 2 to 3 times that instead of staying in the market. Or you can say to yourself, right, at 2 times my risk, I'll take half off, move my stop to entry, and let the other half of my position ride out until the next signal, okay? So the benefit to this is that in any trending market, you know, if price makes a big move, you'll keep some of your position on and you'll catch a large move. Alternatively, if price reverses and stops you out, you still come away with some of the profit. So this is one way in which your actual trade management operation can help you benefit from trading these signals more, okay? And I talk about positive risk reward a lot in these sessions, and it really is the key element to success in your trading, where you should always be looking to bank more than you risk on any one trade, because in the long run, it will make it far easier for you to achieve positive returns. Okay, so we've looked at trading the MACD histogram crossover. Let's move on now and look at the next method, which is signal line crossovers. And these are perhaps another of the most popular way of trading the indicator. So the signal line, as I say, it's this red line here. It's the 9-period moving average of the MACD indicator itself, and it can be used to give directional signals also. So when the MACD line crosses above the signal line, it's a bullish crossover. When the MACD line crosses below the signal line, it's a bearish crossover. Now, typically, what traders will do is look to sell bearish signal line crossovers where the MACD itself is below the center line, and then they'll look to buy signal line crossovers where the MACD itself is above the center line. So don't worry if that sounds complicated. We'll look at an example now, and I'll walk you through that so you've got it. Okay, so here you go. In this example then, you can see from this point here all the way to this point here, the market is in a bearish trend. So we've got this long sell-off, but importantly, the indicator is telling us that the market is in a bearish trend, because we know that when the MACD is below the center line, that means the market is in a bearish trend. So while the MACD is below the center line, we want to wait for situations where the MACD histogram pulls up above the center line, like it does here, okay? So you can see to begin with, the MACD is below the signal line. It then pulls up above the signal line here, and then we wait for it to cross back down below. So each of these red vertical lines I've drawn onto the chart to highlight instances where this has happened, okay? So the MACD line pulls up above the signal line, crosses back down below it there, pulls up above it here, crosses back down below it there, pulls up above it here, crosses back down below it here, and then we get one more one here where it pulls up above it and crosses back down below it. So each time this happens, this is giving us an increase in momentum again. So it's a fresh opportunity to enter the market. So you can see each of these individual occurrences of this happening, with the MACD crossing above the signal line and crossing back down below it, can be used as an entry point to the trend. Now, this style of trading should particularly appeal to the more conservative and systematic traders among you, because what we're actually doing here is building a system with 2 levels of criteria. So firstly, we're pulling up our chart and we're saying, right, which side of the market is the MACD on? Okay, in this instance, it's bearish because the MACD is below the center line. So we're only looking for selling opportunities. And then the only opportunity we're looking for is identifying these crossovers. So our sell opportunity comes only when the MACD line crosses above the signal line and then crosses back down below it. So this is our trigger point for entry. So this is a really great, straightforward, simple system for you to use, which relies on some solid fundamental, some solid basic aspects, which allow you to trade with confidence. Okay, so you've identified the direction that the market is trading in, and you're waiting for specific conditions to enter your trade. So the beauty of this is that it will typically help you to make sure that you're trading on the right side of the market and avoid taking unnecessary losing trades. And also, what you'll find is that you don't tend to get false signals as much, because when the market starts to chop around in range-bound conditions, you won't tend to get the two signals lining up. Okay, so you'll only tend to find these opportunities where the market is moving in a trending fashion. So again, this is a really great system for you to use. And again, when it comes down to how you actually manage the trades, you need to be making sure that you're looking to target at least 2 times your risk. Then again, if you're the type of trader who likes to keep a piece on and keep a runner to try and catch a bigger move, then that's fine also. But at a minimum, once price is hitting 2 times your risk, you need to be doing something, whether that's taking half off and moving your stop or exiting the trade. Now, vice versa, if the MACD line is above the center line, then this tells us that the market is bullish and we should be looking for price to move higher. So we want to find opportunities to buy. So in these conditions then, we look for the same setup but on the other side of the market. So once again, in this example then, you can see from this point here all the way to this point here, the MACD line is above the center line, okay? So we've got a bullish market. So we pull open our chart, we look at the indicator, we see, right, MACD is above the center line. I want to be buying signal line crossovers. Now this time, because we're looking to the top side, we want to see the MACD histogram cross below the signal line and then cross back above it. And this gives us our entry point. So you can see once again, I've highlighted 4 instances of this here. So the MACD crosses below, crosses back above, gives us an entry point there, okay? We then dip back down below, cross back above here, we get another entry point, we get another one here and another one here. So during this bullish move, during this period while the MACD histogram is telling us the market is in a bullish state, we get 4 separate entry points to the trend, based again just on using these signal line crossovers. Okay, so hopefully you're getting excited at this point now. We've looked at a few ways that you can use the indicator, including using it as a directional guide, using it actually to take trades, and within that we've looked at the different ways that you can take trades, including using MACD centerline crossovers, and also using MACD signal line crossovers. Now let's move on and take a look at another way that you can trade the indicator, which is to trade divergence. So divergence is essentially where moves that price is making are not corroborated or supported by the readings that the indicator is giving. Okay, so we've looked at this in a few different technical sessions that we've done. So essentially, what we're seeing is if price is moving higher, but the indicator is flagging up bearish signals, this is divergence. And alternatively, if price is moving lower, but the indicator is flashing up bullish signals, then again, this is divergence. Now, the fantastic thing about learning to understand and to trade divergence is that it can help you gain a really strong early insight into moves in price and help you get some really unique entry points, offering you a strong advantage over other traders. So let's take a look at an example and I'll talk you through this. Okay, fantastic. So you can see here we have a classic example of bullish divergence. You can see price is moving lower in this bearish trend here. So we've got price moving all the way down to this low point here. Okay. Now, interesting, you can see to begin with during the trend. So once the MACD histogram crosses bearish here, you can see that the indicator continues to grow to the downside, okay? So the bars continue to get bigger, and we know that this means that the difference between the two moving averages is growing, and that this tells us that momentum is increasing in the market. However, from this point here where price makes this low, notice what happens with the indicator. So price makes this low, the indicator peaks, making its lowest point. The indicator retreats higher, trades back down. Price makes a fresh low. The indicator, however, puts in a higher low. So we don't pierce the low of that initial low. The indicator puts in a higher low here. Price then retraces again, but then we move down one more time and put in another fresh low. So this is our third fresh low in this latest sequence before we get a reversal. And you'll notice at this point that the indicator once again has put in an even higher low. So we know at this point, even though price has made a fresh low, momentum is dramatically reduced in the market. And this highlights to us the potential that we're going to see a bullish reversal. So we're seeing bullish divergence. So although price is moving lower, the indicator is telling us that there's been a dramatic sea change in sentiment, and this alerts us to the potential for a reversal higher. Now, again, in terms of how we trade this, we can either use our own specific trade setups, such as waiting to trade price as it breaks out above the last swing high, which would be here, okay? So as price trades up above that, we can look to get high. Alternatively, we could draw a bearish trend line along the move, and as price breaks that, we could trade higher. You could look for some specific price action signals, such as bullish engulfing bars. Or alternatively, you can simply wait for the indicator to give you a signal, which it does here, and use divergence to be on the lookout for a reversal. Now, this can be particularly useful in terms of trade management because, for example, if you're in a short position and you're holding on to it and you can see this bullish divergence starting to flag up, you know that the potential for a bullish reversal is in play. And so you know that you either need to be lightening up on your position, e.g. Cutting some of your profits, or you need to be closing the position out entirely, or at the very least moving your stops down, trailing them lower to protect any profits if we see a strong reversal in price. So in this respect, divergence can be really useful, not just in terms of helping us identify trade opportunities, but also in terms of helping us, with our trade management and be alert to potential reversals in price. Okay, so look, I hope that you've enjoyed that session today. That's been a really great, quite a dense session. We talked about quite a lot there. We've looked at some very different trade setups, from basic ones right through to some advanced ones. And we've also looked at ways that you can, build systems out of your trading. So looking to layer up the ways that you actually use the indicator with using center line crossovers and signal line crossovers. And as I say, the beauty of the MACD indicator is that it is, a dual indicator. So it's measuring, it's gauging trend direction rather, but it's also measuring momentum in the market. And like I say, this gives us really useful information, not just in terms of helping us enter trades, but also in terms of helping us manage trades. So before I wrap this up then, are there any questions that I can answer for anyone? Yeah, just to clarify actually, so the indicator then can be used on all time frames, okay? So whether you're trading the H4 charts, the M5 charts, or the weekly charts, the indicator can be used on all charts. And just to also add, so the default settings for the MACD indicator then are 26, 12, and 9. So 26 and 12 are the longer and short-term moving averages, okay, which give you the histogram. And then the 9 is the signal line. That's the 9-period moving average of the MACD itself. Now, these settings can be adjusted, okay? However, you need to remember that if you increase the settings to have higher numbers, this will give you longer run moving averages, meaning that the indicator will be less sensitive to price. And so you'll typically see fewer crossovers and fewer signals. Now, similarly, if you decrease the settings to have shorter run moving averages, this means that the indicator will be more sensitive to price, and therefore you'll have more crossovers and you'll generate more signals, okay? So just remember that. But, although the default settings are great, what I definitely suggest is that you have a play around with the indicator, because I know a lot of traders who have very, very successful systems based on, quite custom MACD settings. So spend some time looking at the indicator on different time frames, adjusting the settings, and see if you can find any other settings which suit your trading style best. Because remember, no matter how useful an indicator looks in a presentation or how useful any other trader finds a specific indicator, it only comes down to how useful you find it and how well you can trade it, okay? So definitely spend some time in the indicator, studying the ways that it moves with price. And also remember, trading with indicators, it's really important to remember they do lag price and they aren't the holy grail, okay? You will have losing trades and you will go through periods where the indicator isn't as successful as it is at other times. But if you spend the necessary time studying the indicator and learning how it moves with price, you can develop solid and reliable trading systems. And as with all strategies, the key thing is learning to identify the conditions in which the indicator works best and looking to trade when these conditions present themselves, and then looking to stay out of the market and trade elsewhere when these conditions aren't present, okay? Yeah, the recording rather will be sent out via email to everyone who's subscribed and joined the session, so don't worry about that. And yeah, thanks for all your accompanying contributions and questions there at the end. And yeah, I enjoyed the session too. So thank you all to everyone, and I look forward to catching up with you all next time. And in the meantime, enjoy studying and trading the MACD indicator. Thanks now, goodbye.